Welcome to our Social Security workshop tonight. My name is Michael Owens. I am the president of Carolina Financial Services Group. I've been an advisor and an agent for 30 years now, so I've been around the block several times. What we're going to discuss over the next 50 minutes is going to be important. The once in a lifetime decision on when to take Social Security, how to take it, could be one of the most important decisions that you will make as a retiree or a pre-retiree. If you make the wrong choice, it could cost you hundreds of thousands of dollars in lost benefits. 70% of people that file get it wrong. 70%. Now, before we get started, this is a live event. So if you would, turn off your phone, click out of any other windows that you may have open, close your door, and focus. Do me a favor, grab a pen and a pad so that you can take some notes. You can also take some screenshots as well. Please ask me questions in the Q&A section. Typically we'll save those questions until the end. The workshop will probably answer most of your questions. If we don't get to your question tonight, please email me. Questions that baby boomers most won't answer. When can I file for benefits? Will Social Security be there for me? How much can I expect to get from Social Security? When should I apply? How can I maximize my benefits? And will Social Security be enough to live on in retirement? And we all know the answer to that one, and that answer is no. Once you make a permanent decision about Social Security, there is no do-over. There are over 500 different ways to calculate the benefits that Social Security offers. For most people, it is not a do-it-yourself project. The Social Security Office will provide the basics, but they will not provide recommendations. So where do you go for advice? We'll come back to that in just a little bit. Now, lots of times I get asked what motivated me to become an advisor and to continue to be an advisor. My motivation is personal. Both of my grandparents had to have stay-at-home care in the last few years of their lives. Long-term care is one of the biggest risks you will face during retirement if you do not plan for it. You cannot have a complete retirement plan without having a plan for long-term care. I would write that down. You cannot have a complete retirement plan without planning for long-term care. Now, my grandmother, her name was Annie. She was raised in a large family of 4 brothers, 4 sisters. My grandfather, his name was Mark, had 2 brothers. They both were raised on a farm. She was a teacher and a principal before she married my grandfather. And my grandfather was a farmer. Now, life is not perfect. My grandfather was diagnosed with Parkinson's disease at the age of 70. This disease took control of his lifestyle. It forced him to have to depend on other people to help him get dressed, to eat, and to even have to get out of the bed. Now, eventually, my grandmother had to hire a caregiver to help her care for him. Now, fortunately, they both had Social Security benefits. My grandmother had a pension, and my grandfather had some other sources of income. You see, you need to be prepared and not surprised during retirement. You need to be prepared and not surprised during retirement. You must prepare for the what ifs that life will throw at you. My grandfather died at the age of 79. At the age of 93, my grandmother needed stay-at-home care. That care cost $36,000 a year, and that was over 35 years ago. Can you imagine what that stay-at-home care would cost today? And he died on Christmas Eve at the age of 95. The webinar will last about 50 minutes. If you stay with me until the end, you will receive or be eligible to receive a special offer. I'm going to give you a sneak peek of what that looks like. Okay, it should be in front of you now. And the offer is this. It is an analysis that uses your personal Social Security numbers. This analysis will help you decide how to maximize your Social Security benefit. So what you'll do is you'll click on the green button there that says schedule your call. When you click on the button, you'll see my calendar. There's a blue dot for each day. You can click on the date that works best for you. Once you've done that, you'll be taken to a second page. And that second page, you will see the time slots on the right-hand side. So you will pick a time that works best for you. And then the final page, on the final page, you will enter your information, leave any remarks that will help you prepare for our call. And we'll go back over this again at the end of the workshop. I just wanted to get this to be a little familiar to you from the start. Now, this all started back in started in August 14th of 1935. This is when President Roosevelt signed the Security Act, the Social Security Act. Now, this was meant to supplement personal savings. It was not meant to replace retirement income. I'd write that down. This was meant to supplement personal savings. It was not meant to replace retirement income. Way back then, the average person would retire and die about 4 years later. The average life expectancy at that time was 64 years old. The government was not expecting people to have 25 and 30 years in retirement. Today, life expectancy is 85 to 90 years old. This is a report. You can go to this site and do what's called a retirement estimator. And you'll see here at full retirement age, at age 67 on the right-hand side, it's circled in green, $2,370 a month. At the age of 70, it's $2,956 a month. 62 is the earliest age you can get benefits. Write that down. 62 is the earliest age you can get benefits. The full retirement age is at 60 to 67, depending on when you were born. FRA stands for full retirement age. Write that down. FRA stands for full retirement age. PIA is your primary insurance amount. This is your benefit amount. PIA is your primary insurance amount. Social Security does three things. One is it provides a guaranteed amount of money. It is supposed to increase with inflation. And it is lifetime income. Fewer and fewer people are actually paying into the system, and many more are actually taken out. My dad took his Social Security at 62. He was scared that Social Security was going to go broke, and he was concerned that he would not live past age 70. Now, I'm glad to report that he is alive and kicking. He's now 85 years old. Is Social Security solvent? It has reserves good through 2034. 2034. These are some new updates for Social Security for 2022. Again, I'd write these down or take a screenshot. 70 million Americans will see a 5.9% increase in their Social Security benefit in 2022. Now, a few weeks ago, the inflation number came out, and it came out at 7.9%. Now, this is the highest it has been in 40 years. Gas has gone from $2 to $4 in the last 18 months. Payroll tax contributions are now up to $147,000. Medicare Part B, the monthly premium for Medicare Part B increased from $140 a month to $170 a month. That's an increase of 21%. That's the same thing as a 21% tax. What happened to only taxing the rich? You need to be careful when it comes to who you're getting your information from. Friends, the internet, advisors, other professionals. Make sure that the information you are getting is current and accurate. So everybody wants to know, when am I eligible to get my benefits? If you look at the chart there, if you were born in 1960 or later, your full retirement age is 67. If you were born before January 1st of 1954, then your full retirement age is 66, and the rest of that is in between. What happens if you apply early for your benefits? You will receive a percentage of your PIA. Now remember, earlier I mentioned to you to write this down. The PIA, again, is the primary insurance amount. It's the amount you get at your regular age, 66 or 67, your full retirement age. At age 62, and if your full retirement age is 66, which is there in the middle, you would get 75% of the benefit. If you apply at age 62 and your FRA, your full retirement age, is 67, you get 70% of your benefit. Now, if you drop down and look at age 66, apply at age 66. If your FRA is 66, then naturally you get 100% of your benefit. If your FRA is 67, then you would get 93.3% of your benefit. Now, what if you apply after your full retirement age? What if you apply after your full retirement age? Write this down. You will earn 8% annual credit. You will earn 8% annual credit beyond your normal benefit. So in this case, if you apply at age 66 and your full retirement age is 66, you will get 100% of your benefit. If your full retirement is age 67, you will get 93.3% of your benefit. Now, if you drop down to age 70, if you applied age 70 and your FRA is, your full retirement age is 66, you will get 132% of the benefit. 132% of the benefit. How much can I receive? Let's take a look at the benefit without the COLA, and COLA stands for cost of living. So if you look at the column that has the yellow arrow that's pointing to the right, that's what I want to focus on for right now. If you take, or if you claim the benefit at age 62, and if your FRA, your full retirement age, is 66, you will get 75% of the benefit. That comes out to be $2,356 without COLA. Now, if you look down at the bottom of the page, PIA equals $3,142. That is the maximum, the current maximum that you could get with the PIA. If you drop all the way down to the bottom of the chart at age 70 and you claim benefits at age 70, you will get 32% extra if your full retirement age is 66. Now your benefit jumps all the way to $4,147. Now, if you will go to the very last column on the right, look up and you'll see the arrow there that points to the left. These are benefits with COLA. Again, COLA is the cost of living. Historically, Social Security has given an average cost of living increase of 2.7% a year. Now, if you wait until age 70, and you, instead of getting the benefit of $4,147, which is without COLA, with COLA, you get $5,132. That is an extra $1,000 a month. Now, this next slide is important. If you go to these websites and you put in your personal information, it will pull up your report. And what you want is you want to get your PIA, your primary insurance amount. We need that information to do your personalized analysis. Write this down: ss.gov/mystatement. ss.gov/mystatement. This is where you can get your PIA amount. Again, feel free to take a screenshot or write that information down. Okay, so let's get started with spousal benefits. Spousal benefits. Spousal benefit is 1/2 of the worker's PIA if started at full retirement age. So in this example, Joe's PIA is $2,000. Julie's is $800. Now, if Julie applies at her full retirement age, her benefit will be $1,000 because that is 50% of Joe's PIA. Now, there are some rules for spousal benefits. This will be another one where I would recommend you do a screenshot or take some notes on this. The primary worker must have filed for benefits. That's your first rule. The spouse must be at least 62 for either reduced benefits or the full retirement age benefit. There are no delayed credits or spousal benefits after full retirement age. The spouse can file a restricted application if they are at full retirement age and if they were born before January 1st of 1954. Now, if you were born before 1954, you will want to schedule a call with us. Divorced spousal benefits. Divorced spousal benefits. This is the same as the spousal benefit if the marriage lasts 10 years or more. If the person receiving the divorced spouse benefit is currently unmarried, the ex-spouse is at least age 62, and if a divorce was more than 2 years ago, the ex-spouse does not need to have to file for benefits. Just remember, if they get remarried, they lose the benefits. Rules for divorced spousal benefits. More than one ex-spouse can receive the benefit on the same worker's record. Benefits paid to one ex-spouse does not affect those paid to the worker. It doesn't affect benefits paid to the current spouse or another ex-spouse. Now, the divorced spousal benefits stop upon remarriage of the spouse. This is another big one. Survivor benefits. Survivor benefits. What will happen to your Social Security income if your spouse dies? In this example, Joe and Julie are married. Both are over their full retirement age. Joe's benefit is $2,000. Julie's benefit is $1,200. Joe dies. Julie notifies Social Security, and her $1,200 benefit is replaced by her $2,000 survivor benefit. However, Julie still loses her benefit of $1,200. So her income goes down, her taxes go up because she has to file single rather than married jointly. This is an income gap that needs to be planned for. Our analysis addresses income gaps, so make sure you schedule a call with us. There are rules for survival benefits. A couple must have been married at least 9 months at the date of death. The survivor must be at least 60 for reduced benefits or full retirement age, full benefit. The survivor benefit is not available if the widow or widower remarries before age 60. And the divorced spouse survivor benefit is available if the marriage lasted at least 10 years. Feel free to take a screenshot or write that information down. Now, there was a situation where a lady was going to get remarried in June. June is a big wedding month. She was going to turn 60 in July. So we asked her to ask her fiance if he would love her for another month until she turned age 60. They didn't know about the rules. Strategy number 1 for maximizing your benefits. A few minutes ago, I suggested that you write this website address down. I think this is the second or third time now that I've mentioned this, and that is ssa.gov/mystatement. The way to improve your earnings record. Now, a lot of times the earnings are wrong. In one of our workshops, there was a business owner whose wife worked with him in the business. He took most of the income, they were married, and therefore his wife did not accrue enough credits. What they ended up doing was they shifted some of the income to her so that she could build up her Social Security credits. Are there any missing years? Many times the reports will have a 0 by the year. And that could mean that they just don't have your information for whatever reason. This can affect your benefits adversely. And this is something, the missing years is something that you really want to fix as soon as possible. Now, can you improve it by working longer? Some people want to do that. They say, look, I took some time off to raise a family, and now I just want to work a little bit longer. You can do that. Strategy number 2 for maximizing your benefits. This is another great strategy. Apply for Social Security at the optimal time. These are huge. Things to consider. Your income needs both now and in the future. They could be different, a lot different. Your life expectancy, your spouse's life expectancy, and your plans for future employment. Are you going to work or not work? If you are you going to make under a certain threshold or go over a certain threshold? Your tax bracket is a part of it as well. So what are the tax implications? Well, if you apply for Social Security before your full retirement age and you work, the following applies. $1 will be withheld for every $2 you earn over $19,560 in 2022. Now, the good news is the benefit will be adjusted at your full retirement age, so you will get that money back. And then the third is to avoid the earnings test altogether. And you do that by waiting until your full retirement age to apply for benefits. Now, there's a lot of information on this chart, and these are tax implications when working during retirement. Under the filing status, at the very top, you'll see married filing jointly. Take a screenshot if you feel like you want this information. If that couple makes under $32,000 a year, the amount of Social Security that will be taxed is 0. Now, if they make between $32,000 and $44,000, up to 50% of the Social Security benefit could be taxed. If they make over $44,000, then up to 85% of their Social Security can be taxed. Now, if you look down at the very bottom, you'll see, and all this is based off of what is called provisional income. So provisional income is your adjusted gross income plus 1/2 of your Social Security benefit plus any tax exempt or tax-free interest that you get. So if you own tax-free bonds, they will use your tax-free interest as a part of your provisional income. So ways to minimize taxes on your Social Security benefit. Again, this is something that's very important. Reduce other income with tax advantage investments. Now, I'm not talking about muni bonds. So what are some of those tax advantage investments? Well, during our call, we'll share those types of investments with you. Now, you may want to draw down your IRA before age 72. So consider doing that. Number 3 is convert traditional IRAs to a Roth IRA. Now, we are in one of the lowest tax periods in history. Our analysis will help determine whether you're a good candidate for a Roth conversion. The next one is delay your Social Security. This reduces the number of years that the benefits will be subject to tax. Reduce expenses, pay down debt, and adopt a simpler lifestyle. You must consider Social Security in the context of your overall retirement plan. And what I mean by that is you have to take into account whether you have a pension, you have IRAs, 401ks, you've got R&Ds that start at age 72, and also your investment portfolios and your employment. Social Security is a part of your retirement plan in general, and all of these variables need to be looked at. Now, I know we have covered a lot of information. However, please do me a favor. The next few slides are important. So I want you to really pay attention and stay focused. If you want to stand up and stretch for 30 seconds or take a few deep breaths, feel free to do that. There are 3 stages of investing. The first stage is the accumulation stage. That's when you're working and you're saving money. The distribution stage, which is number 3, is when you're pulling money out for retirement. So what about stage number 2, the transition stage? This stage is where you are within 5 years of retirement, or you've been in retirement for 5 years. This is one of the critical shifts that everyone should be aware of. You see, the failure to make this critical shift is one of the biggest mistakes that we see people make. And it's not just with your Social Security planning, it's also with your retirement planning in general. Now, you cannot protect your wealth by using wealth building tools. You cannot distribute your wealth or take income by using wealth building tools. I would write that down. You cannot protect your wealth by using wealth building tools. Those are the tools that you use during the accumulation phase. You cannot distribute your wealth by using wealth building tools. So, are you really invested properly for your retirement? Write that down. Are you really invested properly for your retirement? Maybe you're in a situation where you're still investing for growth, even though you're retired. Now, we see a lot of people that say that they're conservative, but when we take a look at their statements, most of their money is at risk. How much of your money is at risk? In this case, the personal goals and the financial goals are at odds. Furthermore, the money is still in a 401k and it's invested in mutual funds. So in order to get income, you are forced to sell shares in the mutual fund. Now, you may want to consider investing for income, not growth. Again, are you invested properly for your phase of life? Are you having to sell shares of mutual funds to get income? Again, you may want to consider investing in consistent dividends and interest as well as interest. Now, this formula that you see is a very important equation. Write that down or take a screenshot. It is TR equals I plus G. TR equals I plus G. Total return equals income plus growth. Interest and dividends is what pays out to you. Growth is when you buy something at a certain price and it goes up in value. Making that transition from the G to the I, again, is the critical shift that you must make. Now, when you're young and you're accumulating, you're in that accumulation phase, you want to grow your nest egg. You don't care if it comes from interest or dividends or from growth. You're able to take that risk because you're getting a paycheck, and that paycheck ensures your lifestyle. And you do not need income from your nest egg. Now, when you retire, you're in the distribution phase. All you care about is the income. You don't care about the growth. You don't care about the total return. You care about how much income your investments can pay out. The I for income will ensure and maintain your lifestyle during your retirement. I'd write that down. The I for income will ensure and maintain your lifestyle during retirement. So let me ask you this. How much of your retirement money should go into the I for income that's going to ensure your lifestyle? And how much should go into the G for growth? Write that down. In the last 20 years, the S&P 500 has averaged about 5.56% on an annual basis. So, you might think that if I'm making on average 5.5% over 20 years, and I'm only withdrawing 4%, I should be fine, right? I should be able to still grow my $1 million, if you use that as an example. However, it does not work that way, because most of us do not understand how averages work with income distribution. And most of us use the re-engineered retirement income method. We're going to go over that in just a minute. Be careful about averages because they do not tell the whole story. For example, my wife and I run on average about 10 miles a week. If you must know the whole truth, my wife runs 20 miles a week and I run 0. 20 divided by 2 is an average of 10. Now, did I lie to you? No. Did I tell you the whole truth? No. This is why you need to be careful about averages. So let's take a look at an example of the re-engineered retirement income method. So let's say you have $1 million. You wanted to take $40,000 a year out. However, you made the mistake of leaving your money in your 401k and leaving it in mutual funds. Now, I also call this strategy if-come. There are too many ifs in this strategy when you are retired. This is one of the worst withdrawal strategies any retiree can do. Please write that down. This strategy is what I call if-come. There are too many ifs in this strategy when you're retired. This is one of the worst withdrawal strategies any retiree can do. Now, when you look at the chart, you'll see that over the 20-year period, the $1 million has dropped to $345,000. Almost 2/3 of your money was lost. Why? Well, look at the red arrows. There were 5 bad years that took away 2/3 of your hard-earned money. Now, you might be thinking, why do most advisors not talk about this method of this income method? In the 1980s and 1990s, we had one of the best stock markets in U.S. history. As a result, most advisors who are here today learned and were trained during that period. You see, they became stock market advocates and stock market cheerleaders. Now that may be great if you're in that accumulation phase where your focus is growing your nest egg and you have time on your side. Now, when you get closer to retirement, you don't have as much time on your side anymore. You don't have the luxury to wait for the stock market to recover during your retirement. So I believe this is why most advisors do not talk about the different income strategies. Now, if you would like for us to do an income stress test for you as part of your analysis on how to maximize your Social Security benefit, schedule a call with us. So, what do smart retired people do? Well, they start transitioning. 5 years prior to retirement, they start transitioning from the growth phase to the transition phase, and then eventually to the income phase as they get into retirement. They used what's called the true income method. The true income method. Write that down for me. Matter of fact, if you can take a screenshot of that as well. If you had $1 million in 2000 and you had a 4% interest or dividend payment, you would draw $40,000 a year, and you would still have $1 million intact 20 years later. So which would you rather have? Would you rather have the 1 million from the true income method after 20 years, or $345,000 after the re-engineered retirement income method? Now, if you want to see how the true income method works with maximizing your Social Security, take advantage of our offer. So here's the bottom line for Social Security and how you should make your decision. There is no one size fits all. You must find the best strategy for your situation. I know you probably still have some questions, and we're here to help you. When should I apply for Social Security? What if I want to keep working? What if I already have applied? How much will my benefits be? How can I coordinate spousal benefits? And this one may be the most important of them all, and that is, what's the best long-term strategy for my situation? So what do you do next? You have two options. You can do nothing and hope for the best, or you can schedule a call with us. Most people schedule a call so that we can cover all the variables with them. So we are now at the end of our workshop. Now, I promised you, if you stay with me, that there would be a special offer. Our offer is a customized analysis based on your Social Security numbers. This analysis will help you maximize your Social Security benefits. The Social Security Administration, this is something the Social Security Administration cannot do for you. They can give you basic information, but they will not make recommendations. Many advisors would charge $1,200 for this type of consultation, and I can tell you that would be worth every penny. However, we are happy to provide a complimentary analysis. This is our way of thanking you for attending our workshop. So you should see my special offer back on your screen. I will tell you that my calendar gets full rather quickly after we do these webinars. So go ahead and schedule an appointment today. I can already see that there are a number of people that have already scheduled a call. What you want to do, and we're going to go back through the process of scheduling a call. Click on the green button. The next window will pop up. You'll see my calendar. It's got the blue dots on it. The blue dots are the dates. Click on a day that is convenient for you, that's most convenient for you. Once you have done that, on the right-hand side are the different times available. So click on a time that works best for you. And finally, enter your information. Please share with us why you would like to take advantage of the offer. Click on the blue schedule events button so that you can submit your request. Now, there is some information that you'll need to have available for the call. And in order to make that time really worthwhile, you will need to know your PIA. And we've gone through how to go and get that number. And we also need your statements available as well. Here's some additional information: our phone number, our calendar link, our email, our company website. Company website has a lot of good information. It's a really good way for you to get to know us a little better. Again, I want to thank you for watching the webinar. If you have any questions for me, I will hang around for a few minutes. Otherwise, take care and have a good night. Here's a question here, and it's talking about taking a large amount of money out of the 401k and being taxed on that, and a question about whether the Social Security would take portions of the Social Security check for a year. Your Social Security benefit will come to you on a monthly basis. Now, what you want to be concerned about with taking a large amount out in a 401k, a couple of things. One is it's probably going to cause, or it could cause, you to go above, if you're married, go above that $44,000 threshold. And if you do that, then up to 85% of your Social Security benefit could be taxed. The other thing that it would do, it could possibly put you into a higher tax bracket. If it puts you into a higher tax bracket, that means you're going to be paying more taxes. So you need to think about those two things in that event. There's one question about at the income methods and how you do that. We will cover those things when we do the analysis with you, and we'll cover all the variables, so you'll be able to see all of the things that are available to you. I don't see any questions at this point in time. So again, take care and have a good night.